RBI's circulars, the process in this has been quite elaborate, and RBI circulated a consultative document, and the entire sector discussed that, and we gave a lot of inputs on the consultative document, some of which the Reserve Bank has incorporated, and it has come out with a circular which will be effective from 1st April 2022. And we are all discussing that the circular has been drafted in a quite effective way, in the sense that it's not like some sort of a RBI speak. It's more of a simple language which can be easily understood and interpreted. That is one of the good features of this circular. But from the sector, our wide range of member institutions wanted to have some more insights into some of the implementation aspects. So for that, we thought that a wider range of consultation would be better. I will not go into the features of the RBI circular. We have our colleague Shamasri Nandan, who will make a short presentation. After that, we have an eminent panel representing the cross-section of the microfinance sector. We have from NBFC MFIs, Sadaf Saeed of Muthoot and Anjan Das Gupta of Asa International. And from Small Finance Bank, we have Mr. Padma Kumar. And from Mainstream Bank, we have Srinivas Bonam. Then from Section 8 company, Mr. Mukul Jaiswal, who also happens to be the chair of Sa-Dhan. He is here. Mr. Papachan Takkakara from an NGO MFI. He is also there to share the concerns of that part of the microfinance. Then Abhijit Ray from Unitas Capital, who are the funders to the sector and advisors to the sector, and have an overall view of the sector. They are also there. So we will be getting a good overview of some of the important aspects of this framework from these panelists. Now, without much loss of time, I request Shamasri Nandan to go ahead with her presentation.
Thank you, sir. I hope everyone can see the presentation now. It's visible on the screen.
Yes, it is.
You have to make it slideshow. Yeah, now it's okay.
It's okay. Welcome, everyone. I'll start with the new definition of the microfinance loan, which has given by RBI, which is applicable to all commercial banks, urban cooperative banks, state cooperative banks, district central cooperatives, and non-banking financial companies, including housing finance companies. The common definition of the microfinance loan, which has been revised by the RBI, is all collateral-free loans, irrespective of the end use of the loan, and irrespective of the application through which the loan is given. It could be physical or digital channel, given to a low income household having an annual income below 3 lakh. Earlier, there was a classification between rural and urban household. Now they have removed that. And this new regulation will be effective from April 1, 2022. And under this new regulation, RBI also said that the not-for-profit who has registered as a Section 8 companies, who have an asset of more than 100 crores have to register as a NBFC MFI within 3 months from the issuance of the circular. That means within June 4th, they have to register as a NBFC MFI. We'll give a small comparison between the previous regulation and the new regulation. Previously, The household income cap, as I already said, was 1,25,000 for rural and 2 lakh for semi-urban or urban urban area. And this was for applicable to NBFC MFIs. Now all the lenders, including bank SFBs, NBFCs, and mentioned regulatory entities have to follow a new household income cap, which is 3 lakhs. Indebtedness, earlier there was an cap on the indebtedness, absolute cap of 1,25,000. Now it has been revised, and the new indebtedness cap is the 50% of the monthly household income. So any time the monthly repayment outgo or the obligation for an household cannot exceed more than 50% of the monthly household income. The loan pricing earlier for NBFC MFIs and NBFCs were either 10 or 12% of the margin cap, so cost of fund plus 10 or 12% margin, or 2.75 times of the average bed raise of top 5 commercial banks issued by the RBI every quarter, whichever is lower. Now they have revised this, and they have given, instead of given a cap on the pricing loan, they have suggested that pricing should be decided by the lenders. So all documented interest rate model have to be given. It should be all inclusive interest rate, and there should be a board approved policy for that. And interest rate will also cover cost of funds, risk premium, margin. These three should be the part of the interest rate, pricing of the loan. And every lender can prescribe a ceiling on the interest rate as per their discretion. Other charges, earlier there were only 3 components of the pricing: interest rate, processing charge, and insurance premium. No other charges can be applicable. Now they have revised it as the borrower shall not be charged any amount which is not explicitly mentioned. So if you are charging anything, you have to mention in the fact sheet. And if anything is not mentioned in the fact sheet format given by RBI, then you cannot charge that. Penalty charges, earlier there was no penalty charge on delayed payment or prepayment. That has been also now is applicable to all lenders. However, they have said that if they are charging the penalty on delayed payment, it has to be on the overdue amount and not on the entire loan amount. So now they cannot charge any payment penalty, but delayed penalty can be charged, but only on the overdue amount. Fair Practices Code given by RBI is now applicable to all lenders operating in microfinance sector. Third-party bundling, product bundling. In that case, RBI has mentioned that no non-credit products should be given in full consent of the borrowers, and fee structure needed to be explicitly communicated to the borrowers beforehand. RBI has also revised the qualifying asset norm. Earlier, the qualifying asset was for NBFC MFIs, it was 85% of their net asset. They have to maintain that. And for NBFCs, it was 10% of their net asset, and they have to maintain that. Now it has been revised that NBFC MFIs can go, have to maintain a 75% minimum qualifying asset, and that is of total asset. And NBFC who are not registered as NBFC MFI and working in the giving microfinance loan can have up to 25% of their portfolio under microfinance. The norms of the qualifying asset criteria has also revised, and it has been aligned with the new microfinance loan definition. Now there is no lender count. Earlier there was a cap on the NBFC MFIs, and only 2 NBFC MFIs can simultaneously give a loan to a borrower. Again, to ensure the collateral-free nature of the loan, RBI has mentioned that no deposit account should be linked with the loan account. Data submission to CICs, apart from the timely, accurate data of the clients, RBI has also mentioned that it is mandatory now to give the household income information to the CICs by lenders, and lenders to use this data to ensure the compliance with the level of indebtedness. Regarding disclosure on pricing, RBI has given the RBI there is no cap now, so lenders can fix the interest rate, but however, they have to give a simple fact sheet, which is also given by the RBI. According to that fact sheet, they have to disclose the pricing related information to borrowers, and this should be displayed. Whatever charges they are charging, they have to display it on prominently on every literature pamphlet on their website, and also in their offices, and on microfinance micro loan cards also. RBI has also suggested that SROs can and other industry association can publish the range of interest rates on microfinance loan charged by their members operating in a district. Regarding repayment, RBI has explicitly mentioned that their lenders should provide flexibility of repayment periodicity, and to calculate the repayment obligation, not only collateral free microfinance loan, they also have to include other type of collateralized loans given to the borrower's household. Collection of the repayment have to be in a designated or central designated place only, and only if a borrower miss 2 installment consecutively, then can field officer can visit them in their house or workplace, in their house. The loan card, under transparency, RBI has mentioned the few things which have to be mentioned on the loan card. Those things are information and identity of the borrowers, simplified fact sheet on pricing, all other terms and conditions of the microloan, and they also have to give an acknowledgement of received and final discharge of the loan, and grievance redressal system of their own they have to mention, and also they have to mention the number of the nodal officer on the loan card. RBI asked for a few board approved policies to be maintained by the lenders. These policies are: they have to have a board approved policy on flexibility of repayment periodicity on microfinance loan, the board approved policy on the assessment of household income. For this, RBI has also suggested few parameters in the new regulation, which includes the parameters of household assets, income, and expenditures. Lenders have to have a board approved policy on the limit on the outflow on account of repayment of monthly loan obligation of an household, pricing of microfinance loans, and also code of conduct for their employees and training and monitoring. Under employment engagement, RBI has mentioned that there should be a board approved policy which clarifies the minimum qualification for the staff, and also provide necessary training tools to deal with the clients, because these are very low income and sensitive client group. And if lenders have to give proper training to their staff on appropriate behavior towards customer. Also, they have to have an incorporate appropriate compensation matrix for their staff. based on the conduct of employees towards customer. Training has to be given, and this have to include necessary inquiries regarding the income and existing debt of the household, so that the field officer can accurately estimate the household income and surplus. There are a few things which have been mentioned by the RBI as harsh recovery practices, which is applicable to all lenders now. These are persistently calling the borrower or calling the borrower before 9 a.m. and after 6 p.m. Harassing relatives, friends, or co-workers of the borrower, publishing the name of the borrowers, use or threat of use of violence or other similar meanings to harm the borrowers or borrower family asset reputation, and or misleading the borrower about the extent of the debt or the consequence of non-repayment. These 5 things are categorized as a harsh recovery practices by the RBI. These are the gist of the new regulations.
Thank you, Shri. You basically, Shamasri's presentation has brought out an overview of the RBI regulations at a single place. Now we go to our esteemed panel. We'll first start with Anjan Dasgupta of ASA International. Firstly, Anjanda, how prepared are institutions like NBFC MFIs to immediately implement the RBI guidelines from 1st April? Do you think that any preparatory time is required? And what are the operational aspects which an NBFC MFI has to take care going forward based on some of the major important aspects? Over to you, Anjanda. You can take about 5 to 6 minutes or slightly more on this.
Thank you, Satish ji. Definitely, yes, we can implement it. I mean, it's just like early Holi for the whole microfinance sector. You know, like, I mean, as they say, the gulal, or as we call abir, you know, that takes out all the negativity and brings in positivity. For us, this regulation is a gulal before Holi. A happy Holi, advance Holi to everyone here. RBI has always been positive as a regulator to the financial sector. You know, I mean, we had total controls, and after a long time, we are long awaiting this. We have got a very positive regulations, and I mean, we will be in a super speed mode to get this implemented. We could get it implemented. I mean, the draft regulations, the draft was already out, and we have been taking the preparatory measures on this. It's only just linking up the various things that ought to be done. The major issues are number one, having the policy guidelines in place, getting the pricing elements, the way they have suggested the pricing is to be done, getting that in place. The data is already available to us. It's only putting it into a template and getting the rates and get going. The major challenges, of course, will be the 360-degree credit bureau analysis, where credit bureau will have a major role to play to get the database into place. It's not only the client's loan that we have to see, we also have to see the client's family's loan and the repayments that are coming in. We would start off in a simple mode, taking out the credit bureau reports of the clients and the client's husband. But subsequently, we will expect that the credit bureau will give us a robust system where we can get a complete picture in a one inquiry form. The formats will have to be changed, not a big deal. That also can be done. The training to staff can also be provided, while most of it that has been mentioned in this circular is already there, especially related to the fair practice code. I mean, there are certain items, not a very long list of items that need to be actually synchronized to get this going. So overall, it's a wonderful regulation. There are certain clarifications that also need to come in from RBI. I mean, for example, I mean, we are very happy that the eligible asset has been reduced from 85% to 75%. But ultimately, the criteria has been changed. They are talking about the total asset. So effectively, I mean, if you make a calculation of it, I mean, the difference. I mean, it's a negative difference, not a positive difference. Where previously we were having certain assets excluded in the net asset. I mean, especially for small MFIs or medium MFIs, there are elements which are sizable. I mean, apart from the non-eligible lending, there are certain assets which are forming a large proportion of the total asset, which was excluded previously, but now will have to be included. So on your initial question that whether we'll be able to implement it, yes. I mean, if we do it properly and if we were prepared for doing it, we could do it very early.
Thank you, Anjanda, for this clarity. Of course, later I will, after one round of the panelists speaking, if some issues crop up, we'll again come back to you. Now, I would like to go to Abhijit, because though he is not from a institution which is actually carrying out the microfinance activities, but the Unitas has a close interaction with the sector as a funder, as an advisor, and as a well-wisher. So, from a ring side, Abhijit, what is your view about this new regulatory framework, and what are the advantages for the sector, and do you envisage any operational or implementation level problems? Over to you, Abhijit.
Oh, sure, Satishji. Thanks a lot for giving me an opportunity to speak. I think we have stalwarts sitting in this panel. I'll try to give a perspective more from a person who's been supportive of this sector, whether when I was SIPB or otherwise now in the Unitas Capital and UC Inclusive, where I support most of the MFIs. Now, it's a very interesting circular, very welcome step because the limit has been increased. But I think RBI is making it very clear that we have to make this institutions much more professional in multiple ways than one. So when the size of the limit has been increased, which is a very, very welcome step, but I think the complexities are also growing, because the focus probably is to look at that, if you are doing an NBFC business, which is akin to a banking business, you should have a lot of systems and processes in place. So the game is becoming much more larger for the big boys, right? It is very clear from the circular, that the gradual step towards moving toward a completely different direction, which is about that NBFCs not lending, has to be monitored, regulated, and looked at from a aspect that, you have a very strong team, you have a very good process and systems, you have to have adequate capitalization, because all these things means you have to also capitalize well. And I think, making the sector much more professional probably. And I'll highlight some of this instead of talking a generic on this. So first and foremost, very clear guidelines all that you should look at household income and very clearly define that the household income has to be, unmarried children and the, person and husband or spouse, right? Very interesting. But what happens with the married children living there? So one has to go slightly deeper to understand how do we document that, right? While I really appreciate Anjanda's point of that, we are all like in a midst of setting it up very quickly, because it's a very welcome method. Yes, it's a very welcome approach by RBI, but I think implementation probably will take a bit of time when you go into the nitty-gritties of it, right? So second point I would like to highlight is, we'll have to report all this, right? The indebtedness part and the EMI part, right? So one is indebtedness we can capture from the credit bureau, but the EMI what we are talking about, or the 50% of the total household income. Now, how the household income and expenditure is calculated can have a different approach from different people, right? Until it's a very standardized approach. So one have to think, one as an industry body, as Sa-Dhan and as MFMFIN and others, we'll have to think of how can we standardize the process of assessing the income. Otherwise, I'll put it income and expenditure in one way, because many of these are cash flow assessment. Like somebody working as a daily laborer, somebody selling tea in a tea shop, the income could vary between my assessment and your assessment. So one has to come out with much more standard processes. Yes, and we can do that as an industry. We can definitely do that. That's something we'll have to think through. Now, coming to the other aspects, like one of the things is that we have increased now rather reduced the 85% requirement to 75%. Now, what it means for the NBFC MFI? Yes, we can do other loans, like whether it is a housing loan, whether it is a vehicle loan, whether it is an MSME loan, or any other loan which are not defined as microfinance. Good, it increases our scope, definitely. But if I look at on the other side, for the NBFCs, it has been increased from 10 to 25%. So what does it mean is that the playing field for larger NBFCs is much larger, right? So that means they are given a much larger game to play. Because for them, as such, 10% was quite a lot. And then from 10% to 25 means they have a much larger play, right? Whereas the NBFC MFI can only diversify to a certain level, which is about 25%. Now leave apart cash available to them, which is about 10-12% they have to maintain because of FDs and other things. So it leaves only 15% availability, which is good. It's a great move. But I'm saying that from the larger ones will get much more advantage position, larger NBFCs, not NBFC MFI. From this perspective, they will have a larger play, which obviously is good from an industry for the client's perspective, because more and more larger NBFC will come to them. They may get a price advantage. From a client perspective, it's great. But from just the industry perspective, we'll have to think through this a bit more. Now, coming to a few other points. One is that the entire process of assessing the income, coming up with the interest rate policy, there's an indicative guidelines. So I think that's where always the larger entities will have an advantage, because their cost of borrowing is lower. They can fix a rate much lower, or maybe they can fix a rate closer to the smaller ones also. So from a pricing advantage, it seems like they'll be at a much better position to be in the market and to probably elbow others. But we'll see how it emerges, because it's too early to say more on this aspect. We'll have to see how things pan out over the years. And the few things on the ground which I wanted to understand also from other practitioners' perspective is that while we are saying household income, we are saying the assessment of looking at what is the total income of the each and family members and looking at the total household loans. So the work perspective, the work for the field officer has to increase much more, right? So when you say the work increases, which means that there's a cost angle to it, right? As such, it's a very, very efficient industry, the most efficient industry in the world, Indian microfinance. So from that perspective, if there is further increase of cost, how will you address the cost? We'll have to understand that aspect. So it's too early to say, but we'll have to understand that aspect. Last but not the least, one thing I wanted to highlight, is the welcome mode of thinking that how the Section 25 would work as an NBFC MFI. So anybody who is above 100 crores has to move to an NBFC MFI guide rule. Now, how will RBI treat from a capital adequacy and other purposes also needs to be understood. Like earlier, the access to grants, or there are capital funds or other aspects, how they were looking at FLDG and other things. So we'll have to see, will all other things be applicable? It seems so. There is no direct linkage on that, because it says only it will follow the NBFC MFI guidelines. So I think Mukulji would be able to definitely throw some light on this, that how he sees this. Getting a registration is not a major issue, but Section 25 with this not-for-profit approach and other things, if the capital requirements are same for those entities, And we'll have to see how those entities can grow. And I would like to understand more from Mukulji in this regard. So I think overall, very positive to see that it is a much more comprehensive circular than we have seen in recent times. The play has increased much more so from a larger entity perspective than smaller ones. We'll have to have much more well-governed systems and processes, whether it is in terms of income assessment or in terms of pricing, which is a very, very welcome move. Now it's up to us as an industry people to figure out how best we can take advantage or try to simplify our process and systems to make it work in the days to come.
Thank you, Abhijit. Now there are various sets of institutions in microfinance, as Abhijit was mentioning, that now there is a greater role for pure NBFCs. Unfortunately, we could not get a panelist from pure NBFCs here, but we have players from other parts. So small finance banks are an important player, especially in the last 6 years, I can say. And how are they approaching this regulatory framework, and what are the measures which SFBs will have to take to operationalize this aspect? I would request Mr. Padma Kumar from ESAF Small Finance Bank to share the perspectives from a SFB point of view on the circulars, and also whether SFBs look at this as a positive to increase their share in the microfinance, or they would think of slightly reducing their exposure to the sector in light of these regulations. Over to you, Padma Kumar.
Thank you, Satish ji, for giving me this opportunity to represent our thoughts on these new directions of RBI. Of course, it is a very welcome move by RBI, and this concept of segment-wise regulation, which is a clear shift from the entity-specific regulation, is something which is a demand. I would like to kind of address the whole thing in certain framework. One is that a brief understanding of how we read this regulation, and there are certain areas where we feel that additional clarifications are required, and there are some conceptual issues, and there are some operational things and some way forward. So this is how I will broadly structure this one and kind of give the response. Okay. Now, to start with, from a conceptual, from an understanding perspective, as I was mentioning to you, currently it is a segment-wise regulation from a sectoral regulation. Then earlier, the concept of indebtedness has changed from loan outstanding to maximum monthly obligation. So earlier, the deciding factor was maximum loan outstanding. Now it is a monthly obligation. Then the most important is that microfinance is considered as a loan to a household rather than a loan to an individual. Now, if you look at the individual, the household is what is being considered for all practical purposes. So if you ask me what is a microfinance loan, I will say that anything which is not a non-microfinance loan is a microfinance loan. So what is a non-microfinance loan? Any loan to a customer not belonging to low-income household. Any loan which has been given to a customer which does not belong to a low-income household, we call it as a microfinance loan as per the new classification. Secondly, if a collateral loan is given to a customer belonging to low-income household, that also is a non-microfinance loan. Apart from these two, everything is a microfinance loan. Now, am I audible properly?
Yes.
Yes. You're audible.
Now, when you look at in a banking parlance, the term collateral essentially means that addition to the primary security. Okay, if we extend that logic, all collateral-free loans means there are, for example, when we are giving a vehicle loan, or when we are giving a housing loan, the primary security is the vehicle, and in the case of housing, it is house. So anything other than that, only other security has been considered as collateral. This is from a banking parlance, and if you look at the guidance of RBI and all, they also recognize something called a primary and collateral security. But in this context, even if they mention it is collateral-free loans, we need to essentially look at mostly that from a loan which does not have an asset backing. But this is a point which needs to be clarified. Otherwise, the implication is that the moment we go by the literal meaning of collateral-free loans, which means even a vehicle loan can be technically a microfinance loan if it has been given to a low-income household. So it is essentially a loan which is not an asset-backed loan, not a collateral-free loan. It's not an asset-backed loan. So this is one clarification which we thought that we should be kind of taking it up, because the implication and ramification of that is huge. Now, the conceptual issues what we were talking is that if you look at the whole microfinance, the majority of our customers are belongings to low-income household and women borrowers. And somewhere a financial independence is what we are being envisaged through providing these finance to these women, despite of the fact that they may have a earning member in their family, maybe unmarried children, they are earning, their husband may be earning. But there are many instances wherein we see that they are not getting, the women are not getting adequate support, and they are taking their own livelihood to take care of the family. So in a way, one side we are trying to create a woman independence and woman empowerment, and this is indirectly, will it create a financial dependency for the woman? This essentially assumes that the children or the husband, if they are earning, they will take care of their family requirement, and in that case, the woman will not get a microfinance loan. Then the question is that microfinance is the only kind of loan which can be made available to these people, so they will be deprived of that. This is a conceptual issue. While broadly this is the direction of the guidelines is fine, but how we will tackle this? Because in our case, majority of the borrowers are women. Second one is that now all these household income again are dependent. Household income determination are dependent on the respected regulated entity, which means that whatever is being reported by one entity can be overwritten by another entity. There are practical aspects around that, but there can be vested interest. Like earlier, there was a regulatory arbitrage. Then there is a possibility of an entity arbitrage as well. There may be interest for an entity to kind of call someone as a low-income household or not as a low-income household. Accordingly, the status of them will be changed. It is not very difficult because the moment we increase the daily wages of a person from a 250 rupees to 400 rupees, automatically the household income also will go for a change, and there is a possibility of self-declared income. So between the multiple reporting, if you want to have someone as a low-income household, there is a possibility, and if you don't want for whatever reason, because if somebody has been brought under a microfinance category, automatically the FOIR and all these things, there is possibility of further exposure is limited. So to that extent, there need to be further clarity around those aspects. Then comes the FOIR methodology. The FOIR, the fixed income obligation ratio, which is what the maximum monthly obligation cannot be more than 50%. While this concept has been widely used, here the essential assumption is that all loan repayments are a monthly obligations, EMIs. But many loans which are having not equated monthly installments. For example, a gold loan has a bullet payment. If you look at a Kisan credit card related loans or an agri loans, these are seasonal loans in repayments are seasonal in nature. Now, none of this will get captured in a monthly obligation. So that will skip there. And again, this essentially assumes that there should not be any product innovation at the microfinance loan as well. The concept of ballooning repayment, step down, step up repayment, initial moratorium, none of these things can be worked out in a concept of a monthly equated installment. The assumption is a monthly equated installment, and the FOIR is being calculated based on that. Another point is that if you look at the table A, which talks about the loan details which need to be given, wherein there are deduction things which are being mentioned, like a processing fee and insurance fees are being considered. Insurance is considered as a charge to the customer. And the practice of the sector is that we provide credit insurance which goes beyond the setting of the loan outstanding. So there is, but that when that is being considered as a charge, the whole and which is being deducted from the loan amount for the purpose of calculation of IRR, it will actually show a higher yield than what exactly we are being charged. The issue is that I think in 3.4 there is a mentioning that there should not be any the interest rate should not be usurious. So what is usurious is a different thing, but as there is a regulatory eye on what interest we are being charging and a perception on the interest rate, this will increase the interest rate more than what we are yielding and what we are being charging. And now comes to the operational issues. Operational issues means essentially we need to get the details of all these. Operational issues depends on various organizations and their level of readiness in terms of technology, in terms of readiness on their framework, on the interest rate, all those things are entity specific. But the things which will be having a larger operational impact applicable to all the organizations are how exactly these households are being identified. Because it's all, because there is nothing like in a credit bureau which will have a household kind of information as of now. So issues around that, reporting of those information and capturing of those things, if it comes to a stage where we need to take the data of all these customers, what I understood that at this point of time, credit bureau does not have any household kind of report. So if we want to check the information, like in case of co-borrower, we need to essentially take the data details, the unique information of these customers and check it with the credit bureau to see that whether they have exposure. So if those things comes in, there is it will be a significant operational effort which need to be taken. If you and the way forward, of course, lot of things rest with the credit bureau reports. One specific thing is that as of now we have been taking MFI CAR. It need to be moved to a combined CAR. I had some discussion with the credit bureaus as well on some of the issues what I had mentioned on the change of the status and how they will be tagging this household income under one report. As of now, they don't have anything. These things need to be built. As of now, what they're having is a combined credit bureau report, which talks about one individual, their loans with other organizations. So the moment we are saying we are looking at exposure of a household, then we need to take the details of the household and cross-check their details to see that what is their exposure in the sector. From a bank perspective, there are PSL implications as well. A direct lending by a bank to a microfinance is not considered as priority sector. Unless by virtue of it being a microfinance, it is not a priority sector. But for lending to a microfinance institution is a priority sector. Why? Because earlier the definition of microfinance itself was not there. So this will pose some kind of issues to the bank. And again, bringing all these things under the household income category, the related classification also will be having some kind of issues unless we carefully look at how that can be tackled. And I see that many customers may go outside the purview of the microfinance as well in many areas. As we start capturing the household income as well, these are some of the issues we need to tackle with. But overall, the direction of the circular direction is fine, but all depends on how we will be able to address these issues and implement it in a proper way. That's my initial thought. Thank you.
Thank you, Padma Kumar. I think probably some of the conceptual and philosophical issues which you raise, I think the sector has to really think deeply, because By talking of household, are we lessening the women's empowerment aspect of the microfinance? I think that question, I think we all will have to think really about that, and whether we are diluting the women focus of our entire microfinance movement. Certainly, those are things we will have to ponder over. Thanks for your insights. Now, along with Padma, we have another banker, Srinivas Bonam. He is from Mainstream Bank, which also has technically the largest MFI under its wings. Though unlike some of other private sector commercial banks, IndusInd was not directly having a vertical. Its involvement and its interest in the sector has always been there. So Srinivas, from the point of view of a mainstream universal bank, how are these regulations going to affect, not only from the perspective of your own bank, but from a general banking scenario? Over to you, Srinivas.
Thanks, Satishji, for having us on the panel. I hope I'm audible.
Yes, yes.
Yeah. Okay. I think great points covered by the earlier panelists, and we tend to agree with most of the points which have already been talked about. It's a great move by the regulator, one, to bring an activity-based regulation and not a legal form-based, which we were used to in the past. I think it's a fantastic move, and also a move which will help address the challenges which we see in the sector today, which is more of a stereotype-based product, which has been the offering for over 2 decades now. We will at the first this thing start looking at a risk-based pricing and a customized product offering. Perhaps that's the way forward, which this regulation will open up to. While the positivity is there in terms of the future prospects, I would like to take a step back, and since we come from the sector, let's try and see why the sector was there at the first place. Are we underplaying some of the challenges which the sector tried to address by trying to bring this this entire approach, which is very close to the retail lending approach? The challenge, if we look back as to why the entire sector evolved and emerged, is that there is a complexity in analyzing and arriving at the household income and their ability to service at a BOP level, where it was becoming a bit of a challenge for them to access formal financial services. That's where this model has come, whether the assessment has to be done by a lending official or are there via media approaches, and that's how we've seen that the peer group perhaps is better equipped to see, and that's how the sector evolved and largely is working on that front. If that be the case, is there a need for looking at a household income assessment across the client segment is one question. And I would like to support it with the data. 90% of the loans which are given in the microfinance sector today are less than 50,000 rupees. Now, if we look at a less than 50,000 rupee loan, do we really have the wherewithal to, I think some of the points which were already covered by the earlier panelists on the complexity involved, both on the assessment of the income and the cost which would go up once we cover it from a comprehensive credit bureau report, needs to be thought through, particularly for the client segment which is looking at a lower ticket size. And this is at least 70%, 80% of the clientele are in this segment, which is the less than 50,000. And in terms of accounts, 90% of the accounts are less than 50,000 rupee loans. And within that, if you further bifurcate, 60% of that 90% is again less than 25,000 rupee loan. So are we over engineering is something which we need to look at. So is there a possibility of trying to differentiate, saying that beyond a particular ticket size, and that ticket size could be arrived at, would it make, because we're not disputing the fact that household income assessment, the FOIR, which is a proven thing on the lending side on the retail, is the way forward. Do we need to do it for the entire segment is one question that we perhaps need to look at and debate further. Second point is the time frame. I think while the draft working paper was available, the circular got released only on 14th March, and expectation is to have the implementation by April 1st. And while a lot of challenges have already been talked about by Abhijit and Padma and the other panelists, it's, I think, a lot of work is involved on trying to live and comply with the letter and spirit of the circular. There is a staff training which is involved to groom the staff to be able to understand and assess the household income levels. There is a process which would require quite a bit of change, because this is not what most of the institutions which are dealing in this segment are used to. Then there is a system related challenge which is also there on how you will be able to configure your systems to be able to factor in all of this data which comes in from the bureau. You will have to first adapt to the CCR, then also understand the expectation of RBI, because the one subtle change which has been made from the earlier guideline to now is the word borrower in the household has been dropped. So it now looks like the expectation, and this is one clarity information which we are also seeking from the regulator. If we have to cover the entire household, then who will be the borrower? Whether we will have to capture the women borrower, the spouse, the unmarried children, then that's quite a bit of task from processing, from consuming the credit bureau reports at all levels, and trying to incorporate and then arrive at a quantum of the credit. And then, of course, the pricing which needs to be charged, which will vary from one client to the other, may not be immediately, but yeah, that's definitely the path that this regulation would take us into. The other major challenge is on the credit bureau data. I mean, if we look at, there are two which are relevant for this segment. One would be the microfinance bureau data and the consumer bureau data. What we understand is that 97% of the microfinance bureau data gives details which will be useful for arriving at a monthly obligation, but when we move to the consumer bureau, the data drops to about 35%. Used on some of the products, for instance, I mean, this is something which is also used on the retail lending side. For a gold, you have a model to see how you will compute for the FOIR calculations and other things in terms of the obligation arriving, whether it's an OD facility, whether it's a credit card, if crop loan, if a loan is maturing in the next 6 months. So there are ways and means, but the only thing is how well we are equipped to consume it in the next few days, which is the time frame which is available. So if there could be an extension of time, that will be welcome move. The other complexity is on a figure which is, I mean, today, if you see, perhaps one of the things will be of interest to see in the sector is the data. I'm sure that in line with the regulation, the income declaration would be around the figure which has been given by the regulator, because it's a declaration basis. If it's 1.6, it is 2 lakhs in an urban, it will more or less be around that level. Now that we move it to the 3 lakh, we will be moving the income expectation, which perhaps may be more closer to the reality, to the 3 lakh figure. But again, if we look at, again, the data point that I was talking about, average outstanding is only 42,000 today, the sector, which is covering about 6 crore odd households. At a customer level, I'm talking about. Is there a need for the, because technically it's only a small percentage of this segment that would be requiring the path that we will have to walk through in the revised framework guidelines, whether it's on household income assessment disclosure to the bureaus, the FOIR calculations and other things. So that if there can be something worked out which tends to retain the simplicity, which is the strength of the business for a large part of the segment, and not apply it with the same brush across, it might be helpful. And coming from the bank, the challenges which Padma has rightfully pointed out, one other challenge from a PSL is there is an end-use verification, which is an expectation from a PSL classification. And we already have a struggle on the micro enterprise classification because the Udyam registration is not available for the unregistered informal segment, which most of the microfinance clientele are into doing a micro enterprise activity, but have operational challenges in getting the Udyam registration, either because they don't have a PAN card or they have challenges on the Aadhaar linked mobile numbers. A lot of operational challenges which are coming on the way. And that's definitely 90% of the MSMEs which keep getting referred to in every forum on a policy framework. So if that can be factored in, that will be very helpful. So while we are very, very positive in terms of what the regulation would do in terms of helping the sector move from a very standardized stereotype product offering on a standard pricing across, it will definitely help in moving to a higher ticket risk-based pricing and a better norm for arriving at the quantum of credit. The only thought that we have is, are we overdoing it on a segment which perhaps may not need with 90% staying below the 50,000, where most of these may not be required. With that, I would end my thoughts.
Thank you, Srinivas. I think clearly your message that for a larger part of the microfinance segment, we have to keep things simple. That's something, and also a big question mark as to whether we are in the pursuit of making it little rigorous for the higher quantum of loans. Are we making the larger percentage more complex rather than being a simple credit product for the people at the bottom of the pyramid? So I think that's something which we can think of and we can discuss with the Reserve Bank. And at this point, I would like to bring to the notice of our panelists and others also is that one aspect of assessment of household income, which is also a part of the credit assessment framework which Sa-Dhan had worked, and just in the last fortnight it has shared with all our member institutions, that gives some sort of a ready reckoner for the institutions to work out, because this framework was piloted in a range of institutions and we got the feedback also. That's something I think our team will engage with our member institutions in a continuous way on this household income assessment framework. Now we have with us Mr. Mukul Jaiswal, who is not only the MD of Cash Power, because with this regulations, a lot of what we can say focus or highlight is on Cash Power, because it's the biggest Section 8 company, and it is the one which will transition into an NBFC MFI, but still be a not-for-profit company. At the same time, Mukul is also chair of Sa-Dhan. That means he has to take care of the interests of the entire sector. So from both these perspectives, Mukul, I would like you to share your thoughts on this.
Thank you, Satish ji. Thank you for inviting me in this meeting. And thanks to Samsri, which had a very crisp and beautiful presentation on the latest regulation. And certainly the previous panelists, Abhijit ji, Padma and Sini, has already spoken and covered this small regulation piece of direction. Okay, just runs into, I think, 9 or 10 paragraphs. Okay, and through this, since everything has been covered, I would not like to touch upon most of the things, but I would like to say is that really microfinance sector has undergone a big transformation, and that transformation has been recognized by the RBI very well. 20 years back, it was microfinance space was dominated by NGO MFIs. And because of need for growth, need us to provide access to microfinance services to poorest of the poor and all the poorest of the country, they needed capital, and many of them transformed into from NGO MFIs to for-profit NBFCs. And then they were categorized as NBFC MFIs post Malegaon regulation committee and subsequent regulation issued by the RBI. But immediately in following 10 years, what we witnessed was increasing number of players recognizing the attractiveness of this microfinance market, because it had become from sector to market. As we used to call in Sa-Dhan earlier days, microfinance sector, now it has become microfinance industry or microfinance market. And the policymakers and regulators have actually supported this microfinance industry post-AP crisis. I would say that now in preceding 10 years, the space is dotted by and the substantial player have become banks, universal banks, and small finance banks. So actually, as was mentioned in the discussion paper as well, now RBI in its wisdom and an approach has really moved away from micro regulation to macro regulation. So the scope and space of microfinance has been expanded further, because if we pay attention to para 2 of the direction, which covers that this applies to universal banks, which includes even RRBs. This applies to cooperative banks and all types of cooperative banks, including local area banks, okay, and NBFCs, including NBFC MFIs. So the scope has been expanded. Similarly, if you see the previous regulation, which was applicable to NBFC MFIs, with a cap of annual household income of ₹2 lakh in urban and semi-urban areas and 1,25,000 in rural areas. So when you read this direction and its applicability to all the players, vis-a-vis definition of microfinance loans, and Padma and Abhijit and very well covered the nuances. But what I see at a macro level is that really, and even it was mentioned that NBFCs which are entering into this space, okay, earlier they had a scope of 10 or 15%, what Abhijit mentioned. Now it is increased to 25%. But at the same point of time, you'll see that with the annual household income of rupees 3 lakh, okay, and every loan which is given to a household having an annual income of less than 3 lakh, okay, can be categorized, and which is a collateral free loan. And as Padma has mentioned, I mean, when RBI is mentioning collateral free loan, we have, as I understand and interpret this circular or carry an understanding of this circular, is that RBI is now suggesting, because of the issues that many banks have been giving microfinance loan and can have a primary security in terms of hypothecation of assets. Okay, so a microfinance loan can even be a secured loan, if not a if it may have a primary security. So the unsecured status of these loans, okay, may change from unsecured to secured as well, if not collateral free. Okay, if we interpret it correctly, and we cannot presume that while issuing this circular, RBI completely ignored and became oblivious of the fact that there are two types of security, primary and collateral security. I think we cannot presume that. So I presume that it allows even microfinance loans to be secured. So many microfinance service providers, NBFCs, and so even our banks, a small finance bank, they can give a microfinance loan, a small ticket size loan, okay, to these households, okay, and their loans would be covered, whether unsecured, secured, okay, would fall within this definition. So given this, I think that the scope has been expanded and focus has been from micro to macro regulation, and further, that's as the government of India has been talking about growing the MSME sector. So many micro enterprises, okay, can also be covered can also be very well covered and brought within the folds of microfinance sector and microfinance loans. Okay, so that's how I see, and it also helps MFIs, irrespective of their legal formats, since it has completed 2 decades or more than 2 decades in India, from livelihood enterprises, supporting these livelihood enterprises and help them to grow from livelihood enterprises into micro enterprises and larger micro enterprises with a higher credit needs. Okay, and it also allows service providers, as already mentioned by previous speakers, to design and re-engineer their loan products, okay, suitably as per the need of the credit need of the borrowers, as per the borrower's risk profile, their business profile and all. So far as microfinance, so far as not-for-profits are concerned, our Section 8 companies are concerned, Satish ji, as you very well mentioned, it's a very welcome step. And I presently, as you have mentioned, Casper is the largest Section 8 company in terms of own portfolio, and but it also helps smaller not-for-profits to graduate and cross 100 crore threshold or 100 crore limit, and then get it registered and get and once they are registered, they would get a recognition. RBI has agreed to regulate larger not-for-profit MFIs. There has been some confusion whether we will have to convert into NBFC MFI. We have sought clarification, and I think our understanding is that we will have to remain, we can remain not-for-profit Section 8 company and can apply as an NBFC MFI registration with RBI. Casper has already been compliance with most of the regulations which were applicable to NBFC MFIs in terms of prudential norms, asset recognition, I think Casper has been having a best asset quality with less than 30 days delinquencies, with more than 30 days delinquencies equal to 0.7% or something. Interest rates around 17.5%. Okay. And capital adequacy around 18-19%. As Abhijit was mentioning, large and organizations like Casper, which has a capital, tier 1 capital close to 400 crores, which can be supported by the subordinated debts. I think it shouldn't be a problem for big not-for-profits, okay, to comply with this regulation. So I welcome this and I stop here. Thank you, Satish.
Thank you, Mukulji. I think what you, Srinivas and Padma have raised regarding whether collateral free is exactly equal to unsecured is something we'll have to look at the nitty-gritty, because probably whether all it can be either way. All unsecured loans certainly have to be collateral free, but all collateral free loans need not be unsecured.
No, I would, Satish ji, I think we must take into consideration the wisdom of the RBI, because the last regulation which was issued by RBI always mentioned unsecured loans. It didn't mention collateral free loan. Okay, in previous circulars issued by RBI. So why did they transition from unsecured loan into collateral free loan? Why? So we cannot say that they were oblivious of this fact.
No, they are. They realize that
it must have been the intentional. This is how I interpret.
Yeah. That's the reason why they use that terminology.
Yeah.
Thank you, Mukulji. Now, from a big not-for-profit, we will come to a small, really not-for-profit NGO MFI. We have Mr. Papachan Tekekara from Vesco Credit, from working in Kerala, basically. So, of course, NGO MFIs are not covered under the present RBI circular, but from Sa-Dhan side, we have been trying for some sort of a framework which will enable the smaller institutions to access credit and funding and all. But that's another aspect. So I request Mr. Papachan to come in with his views on the RBI regulations.
I'm thankful to Dr. Satish and the Sa-Dhan team for making me part of this discussion. At the outset, I acknowledge you thanks that Sa-Dhan for the numerous engagement and interventions for a disciplined and sustained growth of MFI sector. As Dr. Satish said, I represent Vesco Credit, which is a not-for-profit NGO under the aegis of Catholic Church. And among its various developmental activities, the two major areas are promotion of self-help group and microfinance. So we are a SHPI as well as MFI. We have around 6,000 plus active SHGs, predominantly of women. And most of them are engaged in various income generating activities. And our focus is the promotion and nurturing of those SHGs. I made this brief introduction because my take on the debate will be on this perspective. We agree that MFI play a very crucial role in the process of financial inclusion by providing access to the last mile customers. And it is considered as a poverty alleviation tool. And somebody says it is a poverty anti-poverty vaccine. That may be the reason why microfinance first emerged in one of the poorest countries in the world, that is Bangladesh. Okay. And microfinance, which was really practiced by, as Dr. Satish said, it was practiced by NGOs like us, Trust and all this. But we could not meet the demand, and hence bigger players like NBFC banks have come into play. And they have, of course, they have helped the sector to grow to the present stature. Now, it's about more than 2 lakh crores plus business catering to a huge, large number of low-income groups. I mean, let me come to the present master direction, which is very important and which is it is a game changer. I think that new changes are similar to the deregulation of the happened in banking sector in 1994 and onwards. Because I can relate to the changes as a person coming from the commercial banking sector, I can relate to the changes. And this shows the confidence that RBI has in MFI industry, which has now, of course, graduated to a professional level. And Sa-Dhan has done all the preparatory. It's the credit goes to Sa-Dhan that they have done all preparatory works for including that credit assessment framework and all these things. And according to me, this present direction has 2 major changes. There are changes, 7, 8 changes are mentioned in the circular, but according to me, there are 2 major changes. There are 3 major, actually, there's 3 major changes. One is applicability. Applicability is, though Sa-Dhan has put a lot of efforts, people like us, trust societies and all, still kept outside the ambit of this. That yes, rightly mentioned that they is taking earnest steps to get a framework for such for small MFIs like trust societies. I hope that will get through on it. The second and most important change is the definition of the micro loan. I think that has changed the character of the character of the micro loan itself. Now, all earlier micro loans always related to micro enterprise and small business. As somebody mentioned about it. And share of income generating loans stipulated by RBI 75, that was reduced to 50% in 2015 or 16. Now it has reduced to 0. That changes the entire character of the. That means you can have the 100% loan for a consumption purpose. And now the definition has broadened to include any collateral free. That is, there is a, doubtful lot of the collateral. What is collateral free unsecured? That Mr. Palpavaras rightly pointed out that issue, and joined by others. It is a real issue to be clarified by the Reserve Bank of India, because if a vehicle loan is given, a bike loan is given, there is a security for that. Though there may be collateral, there may not be collateral for that, but it is a security loan that has to be. As Dr. Sadish said, it has to be got clarified by the Reserve Bank of India. Then now they say that household income is the only criteria. A household which has a 3 lakh income and less can be considered as a microfinance borrower. That is again taking the character of the microfinance, because the micro enterprises and micro small loans are not taken into account on this list. And the next important and most important thing is the pricing of the loan. Now industry has been left to the demand supply mechanism. I know that industry is jubilant and rejoicing on this. And actually, we have been harping for this change. Reserve Bank has in its wisdom thought that it should be left to the industry itself. But I am a little skeptic about that, because unlike the large ticket borrowers of commercial banks, can the small borrowers of microfinance stand the market demand supply mechanism of the market? That is my skepticism. But I know that the microfinance industry will behave responsibly and judicially, and will not make any issue on that. And my doubt is, will not end up. Ultimately, these small borrowers will not end up in paying usurious rates. That is mentioned. The Reserve Bank has made a mention about that, though they have not made a cap on a definition for that. Usurious rate of interest and other charges also. There, prior to this, there was a cap on a other charges, say 1% on a process fee or 1.5% of process. Now that has been taken away. So that all things is make me little skeptical whether this interest rate and the cost of the borrowers, small borrowers will go to at a higher level. But that has to be. But RBI, in its wisdom, decided to delegate this very important responsibility industry. And we have to be, only thing is we have to be very cautious on this area, which can, because this can go any time wrong way and ultimately give a bad name to the industry asset. So these are the two, according to me, there are two major changes because as a small MFI, not coming under the purview of the circular, other things are not much of important to us. But as a microfinance player, we are complying all the Reserve Bank guidelines to the extent that is applicable to us. And the other changes, of course, there are other changes and there are assessment of household income, limit on repayment. This is all in tune with the general banking system. As a banks, we follow that. We were following that limit on, and a portion of the 50% of the income we use a portion for the repayments. Then conduct towards borrowers, training. All are very welcome. That is an improvement of the existing regulation. And of course, reduction from 85% to 75% of qualifying asset is a welcome change. But the definition of the qualifying asset itself has changed. Now everything has come to that level because there were 7 qualifying criteria, 7 criteria to become a qualifying asset. That has been taken away. The only criteria is only it is a 3 lakh household, 3 lakh household, and collateral free loan. So we don't know how it will affect the companies. Having said these things, I agree that accelerated flow of growth to low-income group in a regulated manner is the need of the hour. And as such, the present master circular is as a welcome thing. And the Reserve Bank is liberalizing the sector in a welcome step. Another major session and in the applicable area, I remember with the gratitude the Sa-Dhan team. They made all the mention, all the efforts to put all the small, including all MFIs under the ambit of the regulatory framework, but it has not happened. Even the suggestions, 2 important suggestions that put forward by Sa-Dhan in response to the discussion paper was one was that this inclusion of all MFIs in a regulatory framework. The another one was inclusion of the credit bureau. That both of them has not happened. It is going to affect us. Because without a proper credit bureau entry, we will not be able to assess the income and of the borrower. That is still continues to be an issue for small borrowers that has not been addressed. And I'm summing up. We as NGO MFI with a large number of SHG members, we used to give financial literacy, and the focus point is on regular savings, and the second one is responsible borrowing and responsible borrowing. Now, I say that it is the duty of the microfinance industry to be a responsible lender. Having liberalized everything, it is our duty to be a responsible lender. I hope that our industry will take note of those things and will add to the glory of this industry and will be useful to the many more small borrowers with the help of this liberalization extended by Reserve Bank of India. So with these small words, I end up and once again thank you for giving me an opportunity, being though as a small MFI and as a member of Sa-Dhan for the last about 20 years. We are very grateful to them for all the engagements and interventions which has helped us. And I hope that Sa-Dhan will continue to do that and get a member, get us included in the framework. That is our long-term demand. And also in the credit bureau. Then only we will be able to, we'll have a, we can say that we will have a level playing ground. Thank you, sir.
Thank you, Mr. Popachan. I think the points which you made for the smaller MFIs, especially the NGO MFIs, to be part of the Credit Bureau platform is very necessary now in view of assessment of a household income from a 360-degree angle, and our advocacy for these institutions will always be there, both with the Reserve Bank as well as the government and NABARD as well as SIDBI. Now, before I go to the last speaker, Sadaf Saeed from Muthoot Microfinance. After all the panelists speak, you can, those who want to raise some issues and question can raise it in the chat box. We'll try to address to the extent of the possibility of time. Some of our panelists also can come in, and or in the participants panel, you can go and raise your hands so we can call on those persons to come in and chip in. And also, after the panelists speak, if we have some of the industry stalwarts, we also would like to hear a couple of words from some of them also. Now I request Mr. Sadaf Saeed of Muthoot Microfinance, one of the biggest NBFC MFIs, to share his views on the operationalizing the RBI guidelines and what are the factors which the institutions, especially the NBFC MFIs, have to take care of and keep in mind. Sadaf, over to you.
Yeah, thank you very much, sir. Thank you. I think pleasure to be here, and good part about being a last speaker is that everything is covered. So I have very little to kind of add. But yeah, I think I should start with really kind of emphasizing and thanking Sa-Dhan, MFIN, other SROs, other agencies, the industry stalwarts, various advocacy groups who have made these concerns kind of visible to RBI, and RBI actually enacted on this and gave us these regulations. As many of the speakers have said, this is a big change, and I call it as a watershed moment. And this is definitely a big move. Many people are calling it Microfinance 3.0 and a complete Sampoorn Swaraj kind of a thing, where we have complete freedom. So to put things in perspective, there is no caps on loan, there is no caps on interest rate, there is no cap on tenor. There is no restriction on end use of loan. So there are multiple kind of advantages that are being given. No restriction on processing fee, no restriction on cross-sell. Income caps have been relaxed from 1.25 or 2 lakh to 3 lakh now. Complete transparency among competitors. So there are many pluses from this new regulation. I think this is completely a big change. Definitely, like it is very advantageous. I do represent my institution, and these are early days in terms of interpreting the regulation. Views are being formed, so I don't claim to represent the entire industry, but definitely, in my opinion, this is a very progressive move. And if you look at RBI's last few circulars, even if you look at banking sector, they have been always talking about harmonizing of regulation. So this is the larger theme there, and they are looking at harmonizing regulation against in every industry, in every sector. So there was a situation where there was a regulatory arbitrage between different entities which were operating, be it banks, be it SFBs or NBFC MFIs and NGOs. But that all is kind of finished now with this circular. And that's a very bold and progressive move. I think the core at it is in the heart of RBI and in the vision is to protect the client. I think over-indebtedness is the biggest concern, and we have seen that in various segments and various sectors, as in various states, that over-indebtedness has really hurt, and it has hurt the client, it has hurt the entire industry, irrespective of what is the legal entity status. So I think with FYR norm put in place, it really puts into perspective that indebtedness is equal for all. Everybody has to look at the customer the same way. liberalizing the income from 3 lakh, from 2 lakh rupees to 3 lakh. We also have to recognize that they have not made a distinction between a rural area and an urban area, because I think that is a very, very right way to look into a regulation, because a rural area in Kerala is very different income class versus a rural area income in Odisha or maybe Bihar. So I think making it uniform makes it more simpler and makes it more even. And it is also kind of a push for most of the organizations to go more and lend more in rural areas, because people who are in 3 lakh income bracket would have more room to borrow, because all of them would not have kind of exhausted their FYR of 50%. So it really pushes in direction of rural areas for all the entities to go and lend more. So I think it's a very, very progressive kind of guideline that have come into place. With it, yeah, definitely there are responsibility of the industry and responsibility of all the lenders. The two key changes are basically there are three key changes, like income, which has been liberalized to 3. How do you assess the income? And you have to really do a practical assessment of income. So earlier, I think not all of us indulged in proper kind of a cash flow assessment, but now this would definitely require a little bit more rigorous effort to understanding the income of the customer. Like FYR has been a norm across the industry, lending industry, but it was never talked about in microfinance. So this is something which is not something new, but it is very a normal term which is used in underwriting in kind of lending business. But this is coming in here, gives you a very, very proper underwriting kind of area to kind of work on. So this will really differentiate a good underwriting or good kind of risk management practices from a poor risk management practices, where people would not kind of be able to assess the income properly or not capture the FYR capturely properly. I think though I've heard Padma Kumar, Mukul and others speak about the unsecured versus collateral free loans. There's a debate, but I think it definitely requires a clarification. But I think the essence of it is that the loan should not be backed by any sort of security or anything. That is what the essence is. That is why even a lien mark against an FD has been specifically mentioned in the regulation that should not be there. So, but I think again, this is something which is should be clarified with the regulator so that everybody has a clear understanding on this. But ultimately, I think the underwriting ability of an institution will determine the success of the institution and the ability to kind of price the credit properly. And if you look at pricing of the credit, there are 3 components that have been mentioned: that cost of fund, the risk premium, and the margin. So that also has to be transparently kind of put out in place. You have to put a policy in place which defines what each element of that pricing is. How do you define cost of fund? We have been working on a formula which has been developed by our SROs. So that formula will work well. What is a risk-based premium? How do you assess risk? Like whether it's just to a customer profile or whether it is related to a territory. How do you define that? That is also very important. And obviously margin. What is your kind of appetite or hunger for profit? So that also will become very transparent. So this is a good kind of a development, and it requires a lot of work from our side in terms of have a very robust policy in place and put it to the board and kind of get it approved. I think often the devil is in the details. So if you look at the annexure that RBI has published, they have very, very effectively put that interest rate declaration that has to be given on the fact sheet to include everything. So for that matter, even insurance that is getting deducted from the loan amount has to be included in interest rate calculation. That can be a little bit of a disadvantage for a lot of institutions because the insurance penetration might drop, or you your interest rate that you are declaring would really reflect higher, because you're also deducting your insurance premium and including that in interest rate calculation. So that can definitely impact. Maybe some work on that is required. But overall, I think it's a progressive move, and it gives microfinance institutions ample kind of room to price their credit appropriately, because currently the biggest challenge that we are facing is that credit costs are higher, and your margins are capped. So definitely sustainability becomes a question mark. So with these kind of things, then you can definitely price your credit accordingly. Areas which are flood prone or which have higher cost of operation can price that loans at a higher rate for those regions and stuff like that. And even you can do risk-based profiling of a customer. There are credit scores given by credit bureaus, so a certain score can command a certain price, and the lower score can command a higher price. So all of that can be played up with. The good part is, I think it's a very comprehensive regulation. So RBI has not only talked about the income, the indebtedness and the pricing, but they have also talked about and emphasized on fair practice code, training of the officers and the employees, and also ensuring that we have a good governing policy on that. So on the recruitment, they have mentioned that the employees recruited should have the skill sets and should be trained. Everything is mentioned there. So I think that's a clear kind of emphasis by RBI that this requires reskilling and retraining of staff. This is a complete kind of a departure from lending, which was a more of a cookie cutter kind of a formula where you just identify people and lend, form a group and lend. But here there is some considerate underwriting that needs to happen. So that RBI recognizes, and RBI definitely recognizes that there is a training requirement for that. And to protect the client, I think RBI has very clearly said that appointment of agencies is also okay, appointment of field collection executive is also okay, but all of that has to be a responsibility of the institution, and certain parameters need to be followed. So those are, I think, welcome developments, but it puts a lot of onus on the institution itself, that we need to ensure that we follow those regulations and we put those policies in place, take necessary board approval. And it also emphasizes a greater role on SRO. SROs would have to publish those interest rates of various entities and make sure that everybody knows what is the lending rate operating in each district. Even RBI has mentioned that they would be putting out the rates of banks which are not regulated by SROs. So there would be a complete transparency. Overall, I think I feel microfinance will expand because your income bracket has expanded. Your room for lending has expanded, not a conventional method of 2-lender, 3-lender kind of a practice. It's more like what is the right credit for the right customer, even if she's in the same group. That would be the right approach to go. And I think it will augur better for the portfolio quality. It will augur better for the growth. And it definitely gives a level playing field to all operator and price your risk appropriately. So I think overall it's great. But before ending, I would also like kind of highlight three aspects that need clarification apart from what already I think Mukul and Padma Kumar and others have identified. I think one is definitely the pricing where the insurance and others, whatever deduction is there, has been included in the calculation. So because this is a different product that we are offering in terms of insurance and any sort of hospi cash or maybe a medical insurance, that pricing should not come into the loan pricing. That is one thing that needs clarification from the annexure that has been provided by RBI. The second thing is there is a definitely liberalization of qualifying asset is there, but effectively, if you look at earlier, the qualifying asset did not include like cash equivalent and other aspects, which mention is missing this time. So which effectively makes the qualifying asset criteria a little bit more stringent and stiffer to follow. So that needs clarification. And then third aspect, I think if you look into detail, there is even a collection methodology which is mentioned that nothing before 9 a.m. and nothing after 6 p.m. should be. Microfinance, if you look at in the traditional format, the collection starts at 6:30 or 7 o'clock in the morning. So I think whether if we continue to follow those center meeting patterns, whether we will be violating the norms, that's need to be clarified with RBI, and something need to be kind of brought into correct square. But otherwise, I think it's all in all very good. Household indebtedness is the way we should look at it, because ultimately what is the debt going to a certain household and what obligation they have to service will determine their ability to repay, or whether they are defaulters or whether they are good repayment customers. So that is very, very important. Credit bureau report, we have been using comprehensive credit bureau report for some time now. We are aware that this is absolutely doable. There are enough information available regarding the household, and there would not be any need to do multiple reports as well. I think a minor tweak of putting additional information of the household members would be enough to get a one report which will give you the comprehensive view. But definitely you would have to move from only the microfinance bureau report to a comprehensive credit bureau report, so that will give you complete 360 picture. But elaborate understanding of the income is very important, and there could be a line of like, how do you assess a trader versus a manufacturer or a service provider? So all of those things, nuances will come into underwriting. But to summarize, I think it's a very, very progressive move. We should be commending RBI for taking this bold step. And I think traditionally, if you look at globally, microfinance is defined as something which is like small in size, and that is given. There is no distinction between whether it is given in a group or in an individual format. So I think we are moving slowly but gradually in that direction. So I think it's a welcome and progressive move, and I congratulate all the people who are behind it. And I think it's a great move for the industry. That's from my side.
Thank you, Sa-Dhan. I think very clearly brought out the point, and also some of the aspects which need clarification from Reserve Bank. Certainly, we can take up that and we can discuss that. Before we take some of the questions and some of the clarifications which our participants have expressed, we have some of the seniors in the sector. Mr. Brijmohan seems to be here, whether he would like to come in and make a few points. Brijmohan ji, are you there?
Yeah.
Yeah, please.
Satish ji, it's a wonderful set of legislation coming from RBI. I never thought that RBI will be so, pragmatic. And what is very easy to see is that there is a clear movement from financial inclusion to livelihood enhancement, something like inclusive growth. All that what we were hoping someday will happen, it has started happening. If there is a serious attempt at, doing what RBI has expected, my guess is that there will be a serious dent in poverty issues. So, to me, it is a wonderful legislation, and we should be very happy about the changes brought in by RBI, and Sa-Dhan and MFIN have played their role in, getting RBI to do this. So happy about it. Thank you.
Thank you, Brijmohan ji. Gigi Maman is also there. While he is from the MFI sector, being the MD of NAPFINS, he also represents the NABARD in a way, the DFI. So Gigi, would you like to, and he currently is on the board of Sa-Dhan also. Gigi, would you like to come in?
Yeah, thank you, Satish sir. Thank you for this opportunity. In fact, I would also agree with the speakers that it's a good move from the RBI, and definitely it's a progressive move. But there are a couple of concerns which already some of them have raised in the by the panelists. One is that see, if I have to go for checking the indebtedness of the family as a whole, then you need to check the you have to check you have to take the report, comprehensive report of all the members of the family members, including the husband, wife, and the grown-up children, adult children. So, is it going to cost us more? Because earlier we used to take only the report of only the member, and that too only the microfinance part of it. But now to understand the overall indebtedness of the family means you have to take a comprehensive report of all the members of the family, all the grown-up members of the family. So is it going to be costly? And can there be an arrangement by the credit bureau that through one reporting, one inquiry, can we get all the information at one go? So this is one thing I just wanted to place here. Secondly, which I also mentioned earlier also, see, because your loan is limited to the repaying the FOIR. In fact, it is a repaying ability based on their income. So if somebody who has already taken a KCC loan, which I am very specifically saying, KCC loan, which is average, it's around 1 lakh. 1 to 1.3 lakh is the average KCC taken by the borrowers. I mean, across the country, I'm saying, and that's the average amount. And in South, if I see, especially in Kerala, Tamil Nadu, Karnataka, and all, there are so many borrowers. Either they have taken KCC or they have taken agriculture gold loan, agriculture gold loan. So all this will become part of their indebtedness, and they are all annual payments. So it will be the entire amount will become an annual obligation for the borrower, and in such case, whether the room for lending for microfinance is getting smaller. That is number one. Now, so can they, this I had raised earlier also in our discussions about this framework. Can at least these kind of things, the KCC loans or housing loan for that matter, the government is very, I mean, very strongly pushing the housing loan under the government scheme, housing scheme. So if somebody has taken a housing loan, it's his ability to borrow more will come down substantially. So that is another point I thought. Third one is that see, if in a family, if somebody becomes, well, I agree with it, it's a good credit discipline their RBI is trying to advocate. But still, if a husband or a grown-up son has taken a loan and maybe a vehicle loan and he has defaulted, so if that is the case, the woman who really wants to do something, wants to take the money and do something, she'll also be denied of a loan because you are seeing the indebtedness of the family. So if one of them will become a defaulter, that entire family will not be able to get a loan. So that lady or the woman borrower who used to take loan from us will also become eligible for getting the loan. So some of my thoughts. Otherwise, it's definitely good. I'm sure this will evolve over a period of time. Some of these things, once you get a clarification from RBI, things will be much better. But then definitely it's a good way. We may need some more clarification, some more clarity on these things. Thank you.
Thank you, Gigi. Looking at some of the issues and questions raised, most of them revolve around this issue of assessment of income at the household level, and to what extent there will be a space for continuing the microfinance lending or further lending to that microfinance client. I think we will flag that issue. We cannot immediately. We have had a lot of discussion on that. There's one query raised. Any of the panelists can come in and answer. Is that whether these regulations are going to be positive for the BC aspect? If some of the MFIs are acting as a BCs in a big way to the banks, in what way it is going to affect positively or negatively? If any of our panelists have experience with dealing with that as a PC themselves or lending to another organization as BC, I would like to ask them to come in. Padma, would you be able to answer on this?
I think this regulation may not have an implication on the BC relation. If I'm talking about an NBFC, there is something called an asset test norm, wherein if more than 50% of your income is coming from non-interest income, then you cease to become an NBFC, something like that, or the classification is based on that. Okay, and there, if the BC income dominates your interest income, that issue is even now it is there, then they cannot be called as an NBFC. There is an issue with the NBFC classification. Now, from here, this 75, 85 to 75 and all, it will not have that kind of implication there. That need to be looked at mostly from a different angle. That is from a classification angle. I don't directly see, but I am just seeing one comment that it may not, this 85 reduction from 85 to 75 will not help much, because 85 is on the net asset and 75% is on the total asset, but that is irrespective of their status as a BC, these issues would be there. As a BC, I see it mostly from a strategic angle, on what extent they need to be having their portfolio management organization vis-a-vis how much portfolio they need to take into their balance sheet.
Thanks. I think that's something which is a good clarification. There are, of course, in the chat box, there is a lot of discussion on the time frame of the applicability. We have institutions which have said that we are ready to implement it from 1st April onwards, because the consultative paper was out in June, and many of the institutions are already in the preparation mode. But there are some other institutions which are also raising the issue, saying that though the circular, as RBI said, can start from 1st April, if some institutions have to have some preparatory time, that flexibility also should be given. I think both views are there. Ranjit, you want to come in from Satya?
Yes, sir. Yes, sir. Thank you for inviting me. So this discussion paper is, out from many months, and we are aware about that. So some of the challenges which member organization has expressed here is in respect to the, income assessment criteria. So income assessment criteria is playbook is already in the market from last 10 to 15 years. Most of the commercial vehicle and affordable housing player is doing assessment based, lending from last 10, 15 years. And RBI is also closely watching that. And those lending is happening based on the household income only, and there is no ITR, there is no salary slip. I have personally seen that. So I don't think there is a challenge in that. It's all about how you are framing your policy in order to make a income expenditure model viable for those customers, and extending a prudent and responsible credit product to them within the overall ambit of 3 lakhs household income criteria, 50% FOI, which is ultimately translating around 12,500 kind of EMI. So organization can start, and if there is any obstacle in between, that can be changed. Board has all those ability and power to decide on, and all those learnings can be incorporated as the journey begins. It is not a one-time policy which has to be approved and fixed for a lifetime. So this is the limited point I want, because deferring any date which is prescribed by the regulation will not go to the regulation regulatory environment, because we are asking, we are demanding, we have submitted all our submission, and then something came, and then now again the pushback for another quarter. There is no never ending story. So that's the limited point. In terms of income assessment playbook, it's all in the market. That's one has to study and adopt based on their ultimate organizational risk profile or risk appetite in a way. Thank you, sir.
Yeah, thanks, Ranjit. Your point well taken regarding the preparatory. I think we also should not constantly bother the regulator with various this thing, and we'll work out we have to only work out a mechanism for those institutions which specifically request some time frame. Only for them we can think of some sort of a flexibility.
Sir, can I ask one question?
Yeah, please.
Sir, if the income is computed, say the household income has been computed and we have extended some loan accordingly, and after 1 year, say if it during the repayment period only, if the income falls down because of the children getting married or because of some other reason, so what will happen if the income falls down? So should we call back the loan, the additional loan?
No, no. So all these things are like you and I borrowing the loan from any banks and financial institutions. They at the time of lending they look at all those eligibility. If someone will lost job and there is income reduced, nobody is going to call your loan unless you are not able to repay. They will definitely start visiting and then all these activity will start. But there is no loan recall notice is a kind of last resort lender look at. So that's not feasible in a way, because once you start loan recall notice, you have to immediately classify that loan as an NPA and the provisioning and everything will hit. So all those challenges will be there. That is not a practical solution and this is not required also.
And another point,
I think Ranjit is correct. The loan has to run its full course, and only when you start assessing for a fresh loan at a later period, you take the whatever changes are there. I think Ranjit is correct because this will be a never-ending process. You can't go on keeping a track of the happenings in a family with regard to the income inflows and outflows after once our assessment is done. So I think the point which Ranjit has made is well taken, because you have to look at from the practical point of view also. What is our bandwidth to do a continuous assessment? I think there was a question about credit life insurance. I think the RBI circular is clear on the insurance part, how the insurance cost should be measured, and also how it has to be done separately from the cost of the loan. But we'll again, because other part of other products which we offer to the borrowers, where an insurance element is there, that has to be separately assessed. I think on some of the things we can still seek RBI clarification. Someone has said, what
add here is with respect to insurance, these are the deductions basis the customer requisition. These are not cost, because ultimately that money, if customer don't pay from his or her pocket, then it has to be provided by the lender. They can pay from their own pocket also. That is a not cost. It's a kind of arrangement between lender, insurer, and the customer. So it's not interest. What we can say in other product, generally it has to be line item reported in annual report in the form of insurance. You have disbursed X much amount, so that can be a kind of a disclosure which can be done. That cannot be part of the cost of the loan.
Yeah, certainly. There someone is asking whether RBI will release the average base rate for March. I think since the circular is coming into effect from 1st April, RBI will not release it. We will have to go by the new circular from 1st April onwards. And there is also a question as to how SRO is going to ensure that the third-party product is not bundled. This aspect, whenever these facts come out, when we do the field visit at the institution level, and if it is explicitly comes to the notice of SRO, then we will take up with that particular MFI, and also if there is a continuous violation, then it has to be brought to the notice of the regulator. Even now that is being done, and there is a wherever facts are brought to the notice of the lending MFI, corrective actions are being taken. Otherwise, if it is persisting, yes, we'll have to consider, Reserve Bank has to consider further regulatory actions on such institution. That is again a continuous process of field level surveillance. And there is also debate in the chat box with regard to the composition of the qualifying assets, whether the exclusions earlier given, since they are not there now, is it not going to make much sense of reduction from 85 to 75%? I think that's something which we'll have to see the fine print, and also if necessary we can request RBI for some forbearance on that. Then there's no issue on such thing. We will only ensure that the flexibility which this circular has given to the microfinance sector, we should be able to make good use of that. What we feel that
Sir, one more question.
yeah, please go ahead. So you're on mute, Mr. Patnaik.
Yes. If two institutions report different income levels for the same household, what will be the impact? That means to CIC.
No, onus of reporting higher income is on the institution. So if you are reporting higher, then you have to prove that it is higher. That's all.
So it is the responsibility of the lending institution at the base level on the assessment of the household income.
So will it not carry any impact on the institution which is reported lower? It becomes just like two different. It becomes just like a controversy or contradiction. So will it not carry any impact?
There is no controversy out here. RBI circular has clearly stated that the person who is reporting higher will have to give a justification. So your justification has to be there how you have arrived at. If you have taken differently, then a justification definitely will be there. You can't do it arbitrarily.
Yeah. So it's not the higher, any deviation, whether it is higher or lower, the divergence need to be justified. So these are the practical issues which we need to kind of see that how things have been coming up. No one has got an answer now, because between a higher and lower income, so the way in which income need to be assessed also, it's a multiplication from their daily household income is also possible. So between a 250, somebody is putting 300 rupees and somebody is putting 350. These will lead to difference in income reporting. But how those can be managed is something which we need to see in the coming days.
No, we are already doing it. Even now we had a limit. Each institution was putting in their income level. Only difference is we are not putting it up to the credit bureau. Although credit bureau had this facility of putting up the income levels. So we are already dealing with it. Here, an additional check has been kept that a justification has to be provided, either higher or lower. It's not that it's beyond our.
Yeah, I totally agree with
capability.
Ananda. The requirement is that your income assessment should meet the FIR norm. That's all. I think if you're able to justify that, that's all. It doesn't mean that you have to have a uniform income across all the industry players. It doesn't. Even in the formal lending sector, a housing loan, if somebody wants to take more loan, they take a co-applicant, show their income and show higher income and take more loan. So I don't think so. Lower income will have any issue. Higher income may be questioned, but you need to have your own justification. That's all.
These are not hard by
Added to that, if you read the notification word by word, that they have said that you have to go back to the member and take a justification from her. Like, I mean, you see in the credit bureau, there is a higher income. Now she's telling you a lower income, or a lower income, you're showing a higher income. You'll have to take a justification from her, how you're giving me this. And if you read the para before that, I mean, your income level is determined among various factors. You're taking bank statements and all that. Is also a oral confirmation from them. So basically, RBI has accepted that it's not a, I mean, voucher by voucher calculation. I mean, you have to use the various sources to get at that figure.
Anyway, in assessment income criteria, even from one organization, 3 people visit same customer, they will give 3 kind of income level. So that's what is ultimately in your underwriting notes or note, that will prevail.
Till now it was differing, but now it is to be reported to a common institution. To CIC it is to be reported. There all
that's fine. Nobody will seek the in a kind of, if I have to if I will assess a customer's income is 3 lakh annual and some other organization will say it's a 3,25,000. They may have some kind of difference in terms of their own assessment criteria or additional information. So they may have that. So you are not here to justify somebody within the industry in order to assess one's customer's income. If there is at all default happens in that customer, that organization underwriting framework will take care of that. If you are liberal, you are taking higher income level. If you are conservative, you are more conservative than you are not considering. So suppose somebody is having 4 cow and 2 is producing milk and 2 is not producing milk. I will take 2 income. Somebody will say, okay, after 3 months, another 2 will also start producing milk. So let's do that because our loan is for 3 years and we are just 2 months away from that, 34 months, 36 months versus 34 months. So these are perspective organization has to take care, and obviously the regulator will not come back to check all those things.
Yes, I was asking the regulatory retribution, if there will be any regulatory retribution or not. So if that is not there, it is okay. Because
that will be not for sure. Otherwise, it will each and every case will have that kind of implication.
Okay.
I have a question to the panel. In the beginning, teachers next problem was testing about credit and typically you have the credit cost.
You are not very clear, Saurabh.
Can you type the question, Saurabh, instead?
Yeah, now it's slightly better.
Okay. Someone is really mentioning about credit and a typical way of calculating this is credit cost. And for an Indian methodology, and it's a known fact that credit cost in Maharashtra is way higher than other. So in fact, charging higher interest rate for state in Maharashtra or district in Applicability is actually a differentiation from a regulation point of view. Anyone, even someone who has other paying, without any basis for the last couple of years, charging them higher than is not
I think to the extent I could hear, what he was saying is that if the credit cost in certain state, like he's giving an example of Maharashtra, is high, and that is built into the interest rate calculation, whether an MFI can have a different interest rate in a different state. That is Saurabh's question. I think Sadaf and Anjan, would you like to come in?
Yeah, there's a clear formula that has been given by RBI, which is cost of fund plus your risk margin plus your risk premium plus your margin. So your risk premium at a state level is different, then you can charge a different rate. There is no kind of stopping on that. But you should be able to justify why you're charging that.
I agree with Sadaf. It's not only state, any segment. I mean, if you feel that that particular segment is a risk zone, even an area which is a flood zone, if you feel that a particular area is a flood zone and you think that the lending there is your risk is higher, you could have a different product, you could have a different rate for that particular area. So that's the, brilliance of this regulation.
May I say something, Mr. Satish?
Please come in.
Thank you, Mr. Satish. And I have some observations. Though the steps by the regulator is very good after a gap of 10 years modification. Anyway, मेरा यही कहना है कि जो सब कुछ क्या होता है lending जो है it is a collateral free lending. So it was earlier the loan size was very less, maybe 10,000, 30,000, 40,000. Now it has enhanced to the income level in this new way. So they can go up to the 3 lakhs even. So it will be good that entire loan should be the collateral free. I think after 1 lakh of loan, I think there should be some collateral. I think if the lending institute thinks that there is need of that, these type of things I think should be there. This is my suggestion. The changes of the attitude of the client also changed, drastically changed. Earlier, after I think the 10 years back or 5 years back, the attitude of the clients and nowadays, that has been changed. So always, I think this is the time for higher loan. Some collateral should be there. And another is the credit guarantee के बारे में कोई भी कुछ नहीं आया है. Like banks and SFB, they can give the loan with their credit guarantee. They have the facilities. In case of microfinance loan, there is no credit guarantee. Another is, now it is also risky. देखिए 2 साल के लिए जो pandemic situation गया है, every microfinance sector, their loss is huge, their assets. So how they can make up their loss? There was no thought in it. Climate change is a point. Major loan is going to the sector, in agriculture sector, there is very much uncertainty due to this climate change. There is the flood, there is a drought, there is this heavy storm, etc. In that case, I think the agriculture insurance, I think that is required. Although government is paying, but that insurance coverage money is not coming to the, like cooperative are getting the benefit. But in case of the microfinance institutions, they don't get it. So there should be some mechanism so that in case of the agriculture lending, so insurance ऐसा कुछ होना चाहिए so that they can make up this loss. Another is there कोई circular नहीं है. As the microfinance sector, there are different players, cooperative, in NBFC, and also not for profit. Also, I think there should be some clear, I think, this circular about the not for profit. क्या इसलिए क्या है, they cannot, this not for profit, they want to avoid all the rules, but they cannot enter into the credit bureau report, etc. They are not getting these benefits, which will benefit the sector.
Maitiji, your points are well taken, and now we are. I think we have also had a lot of points in the chat box, but we are already over time by 6 minutes. I would like to close this consultative meet here, and I would like to thank all our panelists for their contribution and their deep insights, and some of them have other commitments also. Thank you, Anjanda and Sadaf, representing the NBFC MFI sector. Thank you, Padma Kumar and Bonam Srinivas, for representing from the banking sector. And I thank Mukul Jaiswal, Chair Sa-Dhan, and representing the Section 8 companies. And thank you, Mr. Papachan, for representing the NGO MFI sector. And of course, others who have chipped in with their viewpoints and suggestions. I thank all of them. And also, I would like to thank our team, especially Shri, who has made the presentation giving an overview of the regulations. I think a lot of inputs have come. Some of the things in what format, which we will have to take up with RBI. We will again seek inputs from a cross-section of our member institutions and our board, and take it to Reserve Bank. And thank you one and all for joining this consultative meet. Thank you.
Thank you.